Alright, so welcome back to our chapter 12 video. Alright, so last time where we left off, I was doing the transaction for this transaction. And so it's a dividend, so we increased dividends payable on the data declaration. And then our shareholders' equity is going down because, of course, if we know the equation for shareholders' equity or retained earnings, the statement of retained earnings, dividends decreases it. So dividends decreases shareholders' equity. So yeah, dividends are gonna decrease shareholders' equities, and some people like to debit just dividends, and then some people will just debit retained earnings. If you debit dividends, you have to close it into retained earnings at the end of the period. But I don't think you really have to know that for this exam. So just know that this part of the equation decreases shareholders' equity no matter what you use. I think Wiley used like the account called cash dividends. Whatever works. Just know that you're decreasing shareholders' equity and you're increasing a liability. All right. So now it also wants to know what happens when we pay the dividend a month later. So it's going to be the same amount of $80, and now we're actually paying it. So our cash is going to be going down. And this is a decrease in cash. And then we're also gonna we're gonna meet the obligation for the dividend payable. So our liabilities are gonna be going down. And that's gonna be the same amount. So now this transaction was for when we declare the dividend and then when we pay it. But also keep in mind that there is another important date in between them, which is the date of record. So nothing happens in our a journal, no journal entry happens for the date of record. But what happens for the date of record is the company basically kind of goes through who owns the shares on that day. So they'll go and see okay, this person owns 10 shares, so we're going to owe them this amount. So they kind of figure out, who they're actually giving it to. So if there's a question on the exam that says the owner of the stock on the date of blank gets the dividend, it's going to be the date of record because that's when they figure out who they're paying it to. And in her example, she said, or Professor Pendergast said, that if she owned the stock on the date of record and then sold it to me on the day after, she would still get the dividend because she had it on the date of record. So just keep that in mind. And also keep in mind that the order of those days is you declare it, then you record it, and then you pay it. So those three things in that order, and know what happens on each of those days. All right, so other stuff that I kind of wanted to go over was the difference between authorized, issued, and outstanding stock, and kind of the relationship between them. So authorized stock. This is the stock that the company is allowed to sell to shareholders, and it's like the maximum number that it's approved by the state. So this is obviously going to be the biggest of the three between authorized, issued, and outstanding. So now comes issued. Issued shares are authorized shares that have been sold to the public. So if we bought or if we sold 100 shares to the public and then bought 20 of them back as treasury stock, we still have 100 shares out, or we still have 100 shares issued. It's just they wouldn't all be in the hands of shareholders. They'd just be issued, or they wouldn't all be in the hands of shareholders. They wouldn't all be outstanding. Some of them, they'd all be issued, but not all of them would be outstanding. So then outstanding. These are the shares that are in the hands of our shareholders. And so now the relationship that kind of exists between them is that the authorized shares is always going to be equal to or greater than the issued shares, and the issued shares are always going to be greater than or equal to the outstanding shares. And this should make sense because if we're only allowed to have 500 shares, we're not going to have our shareholders buy 600 of them. because we don't have that many to sell. Thanks, because the state sets a limit, and that's how many we can sell. And another kind of relationship that I would maybe know is that hold on. What was I thinking? Maybe I am thinking this. Issued equals treasury plus outstanding. So just keep that kind of relationship in mind. That's all I can really think of for that kind of stuff. So let's talk about what it kind of looks like on the balance sheet. So up to this point, I'm sure you've all heard, her ask, what are the two components of shareholders' equity? And I'm sure some of you, without even thinking, would say, common stock and retained earnings. Well, in this chapter, we've learned that there's more to, the common stock portion. Like, common stock is a part of it, but there's other parts to it as well. So it's still, retained earnings is still one of the big ones. So shareholders' equity. So a big component of it is this is retained earnings. But the other part that used to be common stock, we're now going to call it contributed capital. And common stock is a part of contributed capital. But what else is a part of contributed capital? Well, that's preferred stock and paid-in capital, preferred, and like preferred in excess of par, common stock, and preferred stock. So if we wanted like our total shareholders' equity, we would have to add up all these three and our retained earnings, and then subtract treasury stock to get our total retained earnings. So it would look like this. Paid-in capital plus preferred stock plus common stock, and that's going to give us our contributed capital. Plus retained earnings minus treasury stock. Well, hold on. Yep, okay. Minus treasury stock, and that's going to give us shareholders' equity. So again, what we've learned before is that, it's just common stock and retained earnings, but now we know it's contributed capital and retained earnings. So it's kind of a new wrinkle into something that we've known for a long time. So on other stuff I know for the exam, I remember the equation for the statement of retained earnings, which is beginning retained earnings plus net income minus dividends equals ending retained earnings. Definitely know that, and just know how these transactions can affect that. And another last thing that I saw that maybe confused some people, it was on the last page of your chapter 12 handout. It's taking me a while to erase this. All right. Specifically, when it talks about what is the dividend per share on the preferred stock, so the last page of your chapter 12 handout, number B. So if you look in like the part above, it says there's a 6% cumulative dividend. So a lot of people were confused about, what is that 6%? So that's how they calculate a dividend with preferred shares. So all you have to do to find the dividend per share, I'm just going to abbreviate it for preferred. This is only for preferred stock, keep in mind. You're just going to take that percentage, whatever percentage they give you, multiplied by the par value of the preferred stock. So remember, this only gives you the dividend per share of the preferred stock, the percentage multiplied by the par value of the stock. So then to get the actual preferred stock dividend, you would have to take this number multiplied by preferred shares outstanding. So if you keep all this in mind and you kind of know how these transactions affect everything, I think you'll be pretty solid for chapter 12 on the third exam. So just keep in mind all that stuff and email me if you have any other questions, or if you have something else you desperately